Welcome, my friends. U.S. prosecutors look at short selling in bank shares. Federal prosecutors in Washington are looking into short seller activity around the recent volatility in bank stocks sparked by the failure of 3 regional lenders. Short sellers are traders that profit by betting shares will fall. They have come under scrutiny over the past week as government efforts to steady the sector have faltered and investor fears over the health of regional lenders have deepened. Should this kind of short selling be allowed? Will it kill the banks? Well, it depends on who you ask. What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only your doctor knows your identity. Short selling is an investment strategy in which an investor borrows a security, such as a stock, from a broker or another investor, and sells it on the market, hoping to buy it back at a lower price later and make a profit. To do this, the investor sells the borrowed security at the current market price, and when the price drops, they buy it back at the lower price and return it to the lender, pocketing the difference as profit. The goal of short selling is to profit from a stock's decline in value, which is the opposite of the traditional buy and hold strategy that aims to profit from a stock's increase in value. Short selling can be risky, as there is no limit to how much the stock price could rise, resulting in significant losses if the investor is unable to buy back the stock at a lower price. It is a strategy typically used by experienced investors and hedge funds who are willing to take on this risk. Their activity around the banking crisis is an area of interest for the Justice Department, which is looking for potential securities market manipulation, the person said. Other regulators are also assessing potential market manipulation by short sellers. But the scrutiny by criminal prosecutors, which has not been previously reported, raises the stakes for potential wrongdoers. U.S. Securities and Exchange Commission Chair Gary Gensler and California regulators have said they are watching for any potential misconduct. The standard for launching a formal probe is very high and it is unclear whether prosecutors would ultimately bring any charges. Short sellers arrange to borrow shares they consider overvalued and sell them in the hopes that if the price drops they can repurchase them for less and pocket the difference. They have profited from the banking crisis, reaping $1.2 billion in paper profits during the first 2 days of May, according to data from analytics firm Ortex. Critics say short sellers hurt companies, but short sellers and advocates say they act as an important check on public firms. Last week, the American Bankers Association urged the SEC to probe significant, short sales of bank shares that did not appear to reflect the issuer's financial status, including some that followed favorable earnings reports, the group wrote. We have also observed extensive social media engagement about the health of various banks and the sector generally that appears disconnected from the underlying financial realities, it added. Since at least 2021, the Justice Department and the SEC have been investigating potential manipulation by short sellers and hedge funds around the publication of negative research reports. Short selling can be done by various types of investors, including individual traders, institutional investors, and hedge funds. Individual traders might short sell a stock if they believe that its price is overvalued and that it will decline in the near future. They might also short sell a stock as a hedging strategy to protect against potential losses in a long position or as a way to profit from a market downturn. Institutional investors, such as mutual funds and pension funds, may also engage in short selling as part of their investment strategy. For example, a mutual fund manager might short sell stocks to hedge against market downturns or to generate additional returns for the fund. Hedge funds are known to use short selling extensively, as they are often focused on generating returns in both rising and falling markets. They might also use short selling to bet against specific companies or industries, or to profit from market inefficiencies or discrepancies. Overall, Short selling is a strategy used by investors who believe that a stock's price is going to decline, and who are willing to take on the associated risks and potential losses. However, it is worth noting that institutional short selling is generally not disclosed publicly, as investors are not required to disclose their short positions in the same way they are required to disclose their long positions. Therefore, it can be difficult to identify specific companies that are big institutional short sellers. That being said, some hedge funds and other institutional investors are known for their short selling strategies. For example, well-known hedge funds engage in short selling. Bridgewater Associates, Pershing Square Capital Management, and Citadel Securities. The hedge funds have been known to use short selling as part of their investment strategies. However, it is important to note that these firms engage in a wide range of investment strategies, and short selling is just one of the many tools in their arsenal. There are a number of companies that provide research and data services to investors who are interested in short selling. These companies specialize in gathering and analyzing financial data, market trends, and other information that can help investors identify stocks that are overvalued or likely to decline in price. Some examples of companies that provide research for short sellers include 1. S3 Partners. S3 Partners is a financial analytics firm that provides research and data services to hedge funds, mutual funds, and other investors. 1. They offer a range of services, including short interest data, risk management tools, and market intelligence reports. 2. Muddy Waters Research. Muddy Waters Research is a firm that specializes in uncovering fraud and other accounting irregularities in publicly traded companies. 2. They conduct in-depth research and due diligence on companies that they believe are overvalued or engaging in fraudulent activities, and often publish reports that can be used by short sellers. 3. Citron Research. Citron Research is a firm that publishes research reports and investment analyses on companies that it believes are overvalued or have fundamental weaknesses. 3. Their reports often include a short thesis, and they have gained a reputation for targeting companies that are popular with retail investors. 4. Kerrisdale Capital Management. Kerrisdale Capital Management is a hedge fund that specializes in short selling and activist investing. 4. They conduct in-depth research on companies that they believe are overvalued or have weak fundamentals, and publish reports and other materials that can be used by other short sellers. It's worth noting that the research provided by these companies is often controversial, and can be criticized by the companies that are being targeted, as well as by other investors who hold long positions in those companies. Warren Buffett on Saturday said Berkshire Hathaway is cautious around the banking sector, largely because of poor messaging by officials around government-insured deposits, as well as distorted incentives he said were brought on by banking regulation. A crisis of confidence in the U.S. banking sector has led to the failure of 3 mid-sized banks since March as depositors fled from smaller banks, with calls for the Federal Deposit Insurance Corp, FDIC, to raise its $250,000 limit guarantee on deposits. The messaging by politicians, government agencies and the media around the safety of the banking system has been poor, the nonagenarian billionaire said at Berkshire's annual meeting in Omaha, Nebraska. The U.S. government and the American public have no interest in having a bank fail and having deposits actually lost by people, he said. Berkshire keeps around $128 billion in cash and treasury bills, Buffett said. Part of the reason for that is that incentives in banking regulation are so messed up, he said. First Republic Bank, the latest regional U.S. bank to fail, disclosed that it was offering non-guaranteed jumbo-sized mortgages at fixed rates in its annual report. That's what First Republic was doing, and it was in plain sight and the world ignored it until it blew up, said Buffett, who earlier noted his own father lost his job in 1931 because of a bank run. The incentives in bank regulation are so messed up and so many people have an interest in having them messed up. It's totally crazy, Buffett said. Berkshire has sold some bank stocks in the past 6 months, after having also unloaded some when the pandemic broke out, and now only holds Bank of America, which Buffett said he is happy with. Buffett, the world's 6th richest person, said he is not personally worried about local banks. The American public is probably as confused about banking as ever, he said. You have to have a punishment for people who did the wrong thing, he said. If a CEO gets a bank in trouble, he said, the CEO and directors should suffer. When that doesn't happen, it teaches the lesson that if you run a bank and screw it up, you are still a rich guy. That is not a good lesson to teach the people who are holding the economy of the world in their hands. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.